Mid-June 2026, the Bitcoin market experiences a sudden, sharp 4.5% drawdown. Looking at the Clark-Moody dashboard, we can trace the precise origin of this slide. Right at block height 953,798, the price structure breaks, falling from exactly $66,560 down toward the $64,000 range. For the average retail trader watching the tickers bleed, this triggers an immediate psychological response. They interpret the sudden loss of thousands of dollars in value as a breakdown of the asset's structural integrity. However, this June 22nd heat map reveals a different reality. Sitting perfectly untouched at the $65,000 level, resting above the depressed price action, is a massive cluster of short leverage. The scale shows over $39 million in notional volume trapped in this concentrated zone. The data presents a stark contradiction. The spot market appears to bleed organically, yet someone methodically engineered a $39 million trap resting immediately overhead. This forces us to ask a mechanical question. Are we watching a genuine capitulation by spot holders, or a highly orchestrated sweep of the derivative markets? To answer that, we rely on base layer metrics. This immutable record of network activity allows us to verify the movement of capital behind the price. This split-screen comparison highlights the core paradox. On the left, a downward trending price line shows the volatility experienced by traders. On the right, a perfectly flat graph models network panic metrics. The chain itself is entirely undisturbed. Silence from the network during a multi-thousand-dollar drop is a severe historical anomaly. True market panic always leaves a footprint as participants rush to move their coins. If you want to read these footprints before the rest of the market does, subscribe to the channel for weekly on-chain forensics. Price action alone is currently an unreliable narrator. We have to dissect the weekly heat maps alongside the fundamental block data to extract the truth of this drawdown. Tracing the timeline to June 16th reveals a series of methodical sweeps designed to target specific pockets of liquidity. This heat map captures the initial state on June 16th. Notice the bright yellow liquidation line near $65,500, with the price drifting below it. As price steps downward, the bright bands vanish. The deep purple voids indicate where lower leverage support pools have been completely cleared out. This systematic decay strips the support out from under the asset. It creates a localized vacuum, dragging the price lower and forcing late long positions deep underwater. Over the following 48 hours, support levels sequentially fail. Retail traders watching this view the cascading levels as confirmation of an extended bear trend. Fast-forwarding to June 18th, the result is captured here. The price executes a violent sweep straight down into the $63,000 region. The bright yellow band illuminating at these deep lows confirms the total capitulation of over-leveraged long positions. This mechanism is known as a liquidity hunt. Automated algorithms push the spot price downward, strictly to hit margin call thresholds, creating forced selling events that they can absorb. By midweek, the long support was entirely eradicated. The board was wiped clean, creating the ideal architectural foundation to build a trap for the shorts. Once the lower bounds are cleared, we shift our attention to what is happening above the price action as it languishes at the local lows. Prolonged sideways consolidation at the bottom of a drop is a powerful psychological tool. It convinces aggressive short sellers that the bounce is dead and encourages them to step in with high leverage. By June 21st, this produces a stark visual artifact on the heat map. Look at the intense, immovable wall of yellow liquidity parked at the $64,800 mark. The sheer density of this band shows extreme retail confidence. Traders heavily bet the price will continue breaking downward. This represents the tension stacking in the derivatives market. A massive reservoir of compressed risk is actively building up behind a very fragile price barrier. Market-making algorithms are mechanically incentivized to seek out these exact concentrations of liquidity. Reversing the price to hit that level triggers automatic buy orders, allowing large entities to exit their own positions into the forced volume. The current compression stacks notional risk overhead, aggregating the liquidity necessary to fuel an aggressive reversal. To verify this, we pivot away from paper derivatives entirely. We turn to the network's core dashboard to audit the actual security of the system. The prevailing bearish narrative claims that this multi-day price slide indicates systemic weakness, often pointing to minor capitulation as the root cause. The Clark-Moody dashboard provides a definitive check on this. Looking under the Chain Security tab, the 90-day hash rate sits steadily at 961.6 exahashes per second. This single metric indicates the cryptographic wall surrounding the network is completely undisturbed by the weekly price volatility. Hash rate measures the total processing power securing the network. At 961 exahashes, miners are heavily invested, running their hardware at peak efficiency and expanding their operations. They are not shutting down machines. The physical infrastructure required to produce this computation is staggering. These are entrenched, industrial-scale operations that do not flinch at a 4% price dip. If true spot capitulation was occurring, the miners, whose margins are directly tied to price, would be the first to signal distress by dropping hash power. Furthermore, the money supply and issuance metrics remain totally stable, providing zero evidence of a large-scale exit by stakeholders. The combination of record-high security metrics and stable network issuance offers no data to support a fundamental market exit. The observed volatility remains localized within the paper derivative markets. A final dataset found within the blockspace metrics offers a granular look at market intent during the price slide. When the market actually crashes, we see extreme mempool congestion. Whales and institutions rush for the exits, aggressively bidding up transaction fees to ensure their sell orders process immediately. That the dashboard from the morning of the drop reveals a significant anomaly. The time since last block stretches to 47 minutes and 47 seconds. Despite the network stalling for nearly an hour, the median fee remained utterly flat. This exposes the fee panic fallacy. Many traders falsely assume that a long block delay paired with a price drop means the network is jammed with panicked sellers. This diagram illustrates the mathematical reality. A 47-minute processing delay failing to produce any fee escalation indicates a state of zero institutional urgency. Blockspace is a free market. Because demand for block space was non-existent during a slow block, we know institutional spot sellers were not actively bidding for exit. These flat fees during an artificially slow block suggest that institutional selling pressure is absent from the current price action. We now have two entirely separate datasets telling the exact same story. This composite shows the dead spot market, represented by the flat base layer fees, sitting directly beneath the highly engineered bright yellow short squeeze target. With the lower long support completely cleared, algorithmic capital has only one logical direction to move. It will hunt the compression zone above. Make sure to follow the Twitter account linked below for real-time updates as this specific liquidity trap begins to resolve. The volatility we saw this week is a highly choreographed derivative illusion. The network is mathematically secure, the mempool is quiet, and the $65,000 trap is fully primed to spring.